right. Hi, everyone. Jayce Lowe here at Lighthouse Financial. It's our third installment, third quarter financial planning topics. It's our Java with JC. So let's go ahead and get started. Hope everybody's had a great year so far. But let's go ahead and talk about some third quarter financial planning topics. I basically break this down into monthly topics. July would be a mid-year and high-tech review. July is a good time in the market to take a mid-level year pulse of how the market's doing. Then we jump into August and education planning, kids going back to school, everybody kind of focusing on that. So that's a good time to remind people about education planning. And then a little bonus topic I have in here is career growth and planning for income in retirement. So that's kind of a good thing to add it in there in August. And then the last in September would be estate planning and leaving a legacy. So these are kind of really good topics to hit on this time of year. All right, so mid-year portfolio review and market review. So far for the year, and this is as of Friday, so far for the year, Friday, 8/22/2025. So the S&P 500 earlier this year kind of rebounded from its lows that it had in April with tariff fears and everything else. So far, we're up 9.96% year to date, which is a pretty solid gain for the S&P 500. Inside of that mixture, you think highly driven tech companies and everything else. But if you take a pulse right now, we're already in August. We're up 9.96. Just go ahead and call it 10%. We want to give or take a few. That's averaging more than 1% a month for the market. So pretty solid gains so far this year. So the Dow Industrial Average has a modest gain. Most of it's been aided by NVIDIA in their addition to the index. But we do have some companies in there that haven't done so well inside of Dow and kind of dragging that percentage point down, which is 7.42%. But we have United Health that's had a lot of issues. Merck that's down 12.5%, and then Apple, strangely, Apple down 9%. So these are just kind of the situations that we've seen inside of that. Apple's dealing with a whole lot of other myriad of issues inside of their stock. So just kind of dragging that index down, but still solidly 7.42, which isn't bad. And then the NASDAQ, the highly tech-driven index being the NASDAQ index. So it's outperformed with a year-to-date performance over 11%. So really, really good. So whenever we start to think about themes or sectors rotating in the market or even correlation, we had early year losses that were basically driven by where are rates going to go. Are rates going to go down? Because we hope they don't go up. They've always, this entire year, they've been trying to control inflation. Inflation 2.8%, kind of hovering in that area. Federal Reserve's trying to get it down to 2%, which is historically very low. Because if you think about inflation, it's going to hover for 30-year averages of about 2.5% to 3% inside of inflation. So with rate fears, which, higher 30-year mortgage, you're looking at 6.5%. Going and getting a car loan, sub 8%. Anything else inside of that's going to be pretty hard for consumers to get a little bit of break and to get a little bit of money flush into the economy. So you think of that, and it's been kind of a fear so far this year. Tariffs, that's been, we're seeing how the sausage is being, made in that sense, with tariff fears and everything that we see politically on a day-to-day basis. So that's been a fear. Whenever you think of the stock market, they price in those fears. So that's a reason why a lot of these stocks have been depreciated in value. So, but once we start seeing easing tariffs, retaliatory tariffs are basically taken off the table, you kind of see a rebound in some of these stocks and investments, and you see a recovery. But it also is recovered by easing inflation. We have an improved Fed rate outlook. So far this past week, we had Fed Chair Powell kind of talk and give positive sentiment that they are going to lower rates. But it's not always a guaranteed basis until we see it on paper, until it's there. He can talk as much as he wants. Anybody can talk as much as they want. But until the market actually sees a rate drop, you might not see any movement in the market. And then lastly is the thawed trade tension. So again, you have you lob a softball out there, and basically it's just fears at this point. Some of these trade tensions are thawing out, and it's easing the market. The market's able to correct and kind of move forward. And then the other side of the market, in the bond market, treasury yields are still over 4% for a 12-month treasury yield, which is good. But over time, we know those aren't going to stay there forever. Once you go past 12 months, that rate starts to drop, and that's when you get into the normal long-term treasury yields inside of that. Investment grade bonds are up about 1.2%. And then municipals earlier this year were actually negative, and they've turned positive by, just a little bit, 0.05%. So drivers inside of all these markets is we have slowing growth expectation, diminished tariff concerns, underpinning bond resilience. We just have all of this stuff that's telling us inside of this we have less of an upside, especially in bonds, which typically could drive equity markets higher. So that's just kind of a lot of stuff that we're looking at. And this kind of a mid-year look at the market so far, not too bad. 9.96 for the S&P, 7.42 for the Dow, and then NASDAQ at 11. All right. So AI and tech leadership. So this is the biggest thing that we've seen inside of the market growth for the past few years has been technology. AI, especially that last year, started to get a big influx into the market and where that growth is going. It's dominating equity gains. Last year, it was the Magnificent Seven. So we had Apple, Microsoft, Amazon, Google, Meta, NVIDIA, and Tesla. That were the 7 stocks that were driving over 60% of the S&P 500 performance. Now, this year, we have the Fab Four. So these 4 stocks are accounting for 60% of S&P's performance so far for the year. And that's NVIDIA, Microsoft, Meta, and Broadcom. So all those are actually pushing that index forward. And kind of similar to what happened last year. Midpoint in the year, those were, Magnificent Seven stocks were basically making the market positive, and then you had a broadening out event of every other sector started to participate. So it was actually really good. So whenever we think of AI market outlook, is it true? Is it legit? Is it just a bubble? Is it anything else? It's kind of a lot of things that we start to look at and start to monitor. So far, in this year, the total global AI market in 2025 is $638 billion. So they are forecasting it by 2034, it's going to rise to 3.68 trillion. So a lot of money going into AI markets, a lot of it going in there. The US holds about 40% of the global market share, which is good. You think about NVIDIA, you think about Intel, Microsoft, all of these major players inside of AI and tech are actually increasing and getting larger. So we'll take a look at a lot of fundamental data from AI companies just to see exactly where the revenue is driving, cash flow, and everything else. And so far for quarter one, NVIDIA's revenue was $44 billion. Now, that's really good. And you start to think, okay, they're a profitable company. Where are they going in the future? And in the future, this is something that we've seen in the market, that $39 billion of NVIDIA's revenue is going into data centers. So a lot of these AI companies are actually expanding data centers because they have the chips, they have everything else, but they need the operations center, they need the brains. They need these huge data centers to collect information and to be able to run a lot of the artificial intelligence. So especially this year, data centers have been a big component for AI growth. So that's kind of something that we're watching and, kind of taking a look at, especially in our portfolios and indexes that we monitor. So AI startups inside of this year. So if you think of venture capital companies or anything else, AI startups captured $73 billion And that accounted for 58% of venture capital deals, which is pretty big. That's pretty massive. That kind of tells you that growth in that industry is starting to rise. So, the takeaway from all this, right? All we see at this point is positivity, especially if you're looking at the market, you see everything that's going up in tech and AI. Now, you do have to stand back. You have to pull yourself back a little bit, and you have to understand the AI stocks, high upside, but also very volatile. So they can go up and down inside of major market movements. You think of Tesla last year and now this year. You think of Apple last year and now this year. So very volatile from year over year. And I bring this point of talking about beta. Beta is a measure of risk that we use in our portfolios. And just kind of give you an example, the S&P 500 beta is 1. And if a stock has a beta of 1.6, it means that it's more volatile or riskier than the S&P 500. So it can gain or grow more. 1.6, if it takes on more risk, which means higher upside and reward, but also more risk means bigger downside. So 1.2, more risky than the S&P 500. 2.2, that's telling you that AI stocks are averaging between 1.6 and 2.2. So the 2.2 beta means that it's 2 times more volatile than the S&P 500. So that's pretty good risk inside of that investment. So those are a lot of things that you want to watch and kind of look at. So with anything else that we look at, it's always cautious signals that we're going to tell people and kind of go over. So concerns over valuation. And that bubble risk, right? You're hearing about it right now in the news. They're talking about bubbles. They're talking about anything else. Are we going to have a potential worse loss? Are we going to have something similar to the dot-com crash? Dot-com crash was highly overvalued investments that weren't really legit, and then the bubble pops. And that's basically what the cautious signals are. Is if it's a small company in AI and you're expecting a huge amount of growth inside of that, that's a big caution, is you don't want to put all of your eggs in one basket. Diversification is key. It is absolutely something you want to focus on and think about for the future, is diversification in your portfolio. All right, so the 2025 outlook and what we've seen so far. So consumption and domestic resilience have really kind of pushed the market and continue to push the market forward. Despite inflation and weak job data and unemployment and stuff like that, consumer spending, it remains firm. Retail sales grew by 0.5% in July, and it's supporting that with market strength. So us U.S. consumers, domestic consumers, we have a consumption addiction, and that's basically pushing the market forward. So we do like to buy, and as long as we have jobs and everything else, we are going to consume. We are going to do that. So that is a good resilience key thing inside of this, is taking a look and seeing exactly where the market's going. So ETFs that are tied in retail and discretionary sectors are seeing strong inflows, which kind of tells you, again, even though you might have negative information out there, consumers are still going out and buying. They're still going out and spending and everything else. So it's kind of good stuff to look forward to. So forecasts and the forward view. We're always going to try to take a look at where we see certain indexes, where the growth is, where the targets are for the end of the year. Wall Street as a whole has basically giving price targets for the S&P 500 at 6,600 and 7,100. And that can kind of be backed up with earnings reports and potential Fed cuts. This is kind of something that everybody was banking on this past year, was that they're going to lower interest rates. So we're going to see this market boom. But sometimes that can make you very reactive, inside of investing. It can make you emotional and everything else. So these are the forecasts. Doesn't mean that necessarily it's going to happen at that point in time, but this means that this is where the price targets are. This is where we expect certain things to happen. And that kind of gives us a lot of confidence in the investment portfolios that we manage. Is if the forward outlook is positive in that event, it's going to give us a lot of good key insights. All right, so we talked about AI earlier, but we do need to talk about a little bit of emotional behavioral finance investing, and the fear of missing out. Anytime we get emotions into investing and we're trading rather than investing, that's when we get ourselves in trouble. You know, we're all going to tie all of this stuff to maybe our day-to-day actions. If we're looking on social media or if we're listening to a news outlet or anything else, it's all going to be very emotionally based. So most people might think, oh my gosh, I'm missing out on everything. I gotta get in right now. But that whole point is, well, why are you getting in? Are you getting in because of whatever you're hearing on CNBC, Fox News, whatever? Is it social media buzz? Is it daily market records? You know, we kind of keep a pulse to the market. We hear about everything that happens every day, and it is emotional driven. So, and it's going to make you come to I guess a four-way stop of what to make, what decision you're going to make. And you have to make a decision. You don't have to make a decision. So, investing small points in time and investing a little bit over time, being diversified is the best investments that you can do. Trading on a day-to-day basis is just going to drive you up the wall. And that's typically what happens, and it folds into behavioral finance. So investors are typically going to buy high and they're going to sell low, and they sell low out of fear. So once you get through that business cycle, or once you get through that cycle of that company, if you are buying in that event, you're going to be emotionally driven. So when everybody's happy, when everybody's exuberant, everybody's investing. When everybody's sad, when everybody's fearful, they sell. And that's basically what happens. You just go through that constantly. So, this is kind of something we're watching in the market as well, is AI. Is it a legitimate growth story? Or is it basically shoveling in capital from investors in volume on a day-to-day basis? Is that driving the market forward in those investments, or is it legit? I'm not saying either one is that, but that's constantly a thing that we are looking at and valuing in the market. And valuing that point, kind of understanding of where you need to be invested, risk tolerance and risk should be a foundation of your investments. At the end of all these really great information about the market, I'm going to hear the story from a lot of people is, am I missing out? Do I need to participate? Do I need to do this? Your risk tolerance is always going to gauge where you need to be invested. The risk tolerance is going to say, hey, if the market falls by this much, are you comfortable with still being invested? If we if we drag out historical performance to, any sort of market, we know that 70% of the time the market's going to be positive. And if we can basically go, well, now I got to go risk-based to however I'm invested, what my financial plan looks at, what my distribution rate is, how often I take distributions, how much longer I'm working for. There's a lot that goes into trying to value your risk in your portfolio, but most of it, quite honestly, it's not driven by risk. It's driven by emotions. It's driven by participation in whatever investments people want to participate in. So your investments portfolio should reflect your personal risk score, not the market's mood. And it should be your mood, your situation of how you're invested, because great days you're going to be happy, bad days you could be sad, but that is in some senses where you need to be invested, which is risk. So you want to avoid the all-in bets, and sometimes this is a big thing. Sometimes the best move is no move, but sometimes missing out on some upside is often the price of avoiding a devastating downside. So that is a good thing that I constantly remind myself and clients. All right. So we're out of investments. Now we're into August. So education planning and why to plan for education. So pretty obvious of why you should want to plan for education. But the biggest thing that most people grapple with is, well, are my kids going to go to school? Where are they going to go to school? How much do I need to save? Starting earlier is the best because college costs have risen 4 to 6% every year for the last 20 years. They're never going to change. And this is a national average. This is not California average. It's going to be more expensive in California, New York, and any other state that is expensive. Average of national colleges of public in-state is $28,000 a year. Public out of state is about 46,000, and private school is 59,000. So, as I said before, starting early because you get the compounding effect in investing. A newborn today could face 4-year costs exceeding $300,000 a year in private school. So that's going to kind of be backed up by the family. Um, most of the situations where families can get help inside of that, it's going to be, if a family saves and helps out for it, your savings are probably going to account for about 30% of college expenses. And you think about it nowadays where most people cannot save that much unless your mortgage is, 10 years old and you're, way, way under the eight ball of that, and your expenses aren't out through the roof. So 30% of the college expenses are going to be covered by savings, which the remaining 70 are going to need to be filled up with something. It's a vacuum. It needs to be filled with something. So you can you can go after federal loans, but they're going to carry limits. They're going to have income-based caps. It's typically going to be on the parents. Parents going to be making all the money. Kids aren't going to have anything. So there's just going to be a lot of negativities and stuff like that if you try to go the loan route. And anything else, an unplanned gap, you can talk about parent plus loans, but again, 6 to 8% interest. You can do private student loans, but those are a little bit, they can be dangerous as well. And then also is tapping into retirement accounts. You really don't want to do that because if you're not 59 and a half, you're going to get hit with penalties of 10% penalty, and it's going to be taxed as income. Not really something you want to do. And even into retirement, you're taking away your retirement funds. So hopefully you can fund education, but that's taking away from your retirement. So the core funding vehicles, on outside of planning and saving yourself, or saving for yourself and kind of putting it into a savings vehicle, there are ways to fund education. The most popular one is the 529 plans. So those are tax-free growth for qualified education expenses. You can do 19,000 per person per year into that. So you can actually do a 5 years combined of contributions, which it would be, let's say a married couple combined could do 190,000 at 1 year. So you can do 5 years all of a sudden. So the 529, you can do gift tax, gift types of gift funding inside of that. You can, and they've been the most popular because you can fund it the most, and it's just got some really good benefits. Right under that, you've got the Coverdell Education Planning accounts. Those do give you tax-free growth, and they can cover K through 12 expenses. But the annual contribution limit for those are $2,000. You're a little bit more open on the investments, so you can invest in stocks and anything else. 529 plans are typically state-ran with mutual funds and ETFs, but Coverdells you can actually invest in stocks. And then one right under that are custodial accounts. So custodial accounts are if you have a grandchild or child and you want to start funding or investing, but they're not over 18, so they can't really hold the accounts. So you, as the parent or grandparent, become the custodian, and then the child is the beneficiary. So inside of that, there are UGMA and UPMA accounts. And I have in parentheses the Vegas accounts. These once these kids turn 18 or whatever the age of past being a minor gets, it's their money. They can do whatever they want with it. They don't have to use it for education funding. They don't have to do anything. They can take it and go wherever they want. So that is kind of a risk inside of doing that and funding for that. Then you have scholarships and grants. Very difficult to do that. And I wouldn't plan on all of our babies being scholarship bound, because as it says, it's very competitive. It's free money, but it's very hard to get it. Grants themselves, you've got Pell Grants where those can basically be, low income family. Federal Pell Grants can actually really help out, but it's first come, first serve. And you have to do it every year very early compared to when you probably want to start thinking about school, but you have to do it. And then the last is cash flow funding. So you're setting aside a part of your income annually for tuition. But really, honestly, how much can you set aside? Not very much with how expensive things have gotten. So you have to have that backup. If you are saving into it, you want some sort of investment. So if investments are growing, average, I don't know, the S&P 500 for some situations, say if it's growing 8% a year, that's an extra 8%. So if you're saving 10, then realistically you're actually saving about 18% in that situation. So can't save that much, so you have to use investments as a backup. Okay, so a little bit more of a deep dive into 529 plans because they are the most popular. So it's flexible, so you can use it with college, trade school, and now up to $10,000 a year in K through 12 tuition per year. So tuition, room and board, books, supplies, computer, internet, and college fees. Those are the expenses and the qualified expenses that they will accept. So you pay no taxes on interest or growth on distributions if the funds go towards a qualified education expense. So if the kids want to go to spring break and they want to tap into the 529 plan, or if they want a new car, these aren't qualified expenses. So you're going to be hit with a 10% penalty plus income taxes on unqualified distributions. So pretty hefty, for certain situations. So the investment options can be age-based or custom portfolios. You can go aggressive, middle of the road, or balanced or conservative, or whatever you want to take inside of those, or it can be age-based where every year it gets closer to the year that the kid is going to be entering school, it will get more conservative. And the risk and allocations are those is early years you can be more growth focused because the child is going to have 18 years to invest. Middle years you want to start gradually shifting that to more of a balanced portfolio. And then in the final years you want to get really conservative, because you want to preserve capital and you want to preserve that 529 plan balance so that the child can grab it without being victim to volatility in the market. So again, you want to avoid high volatility near the withdrawal time. So going more conservative as the child gets closer to 18. So newborn, midpoint, maybe 10 to, whatever, 10 around that year, you still have enough time of 8 years until drawing it. And then once you get closer to the final years is when you go conservative. All right. So kind of shifting gears, career and income growth. So the reason why I put this in there is it's always a good reminder for all of us to kind of understand and see how people move forward in life, what career objective, what things that they have moving forward inside of that. All right, so the average earnings peak is between age 45 and 55. So if you have somebody that gets out of college and they think they're going to be making 6 figures and everything else, it doesn't happen. You're going to have a lot of years put into whenever you graduate college or just whenever you get in a solid career of when you're actually going to be earning as much as you're ever going to earn. And that's 45 to 55. So the key inflection points in a career is the first 10 years, your fastest wage growth is through skills and job changes. My first 10 years in the industry was getting licensed, proving to the companies that I was with that I could actually do the job and everything else, but I was earning every cent of that. I was trying to move forward in my career, getting more credentials, getting more of everything else to just kind of keep shifting it forward. So mid-career, your growth inside of any sort of career can slow down, and it depends on how active you are of moving your career forward. So if you start to slow down, that is going to slow your career down. And that's when you get people burning out are just not wanting to do the job, or maybe they start to shift careers because it's not something they want to do. Um, but that's basically what happens inside of those, situations with career growth. So you want to stay proactive. You can shift your curve higher, but it depends on just where you want to go with it. So the way to move forward, you got skill buildings, certifications, advanced degrees. You can do some cross training inside of, moving forward in your career. You can network. I would be careful with networking. Sometimes it can be a waste of time if you're not networking in the right areas. It can expand opportunities. It can accelerate promotions, but you always want to be focused on what makes necessarily you happy. Chasing the money, in sense, and we'll kind of talk about strategic job changes. Just chasing the money can ultimately end to being a very unhappy life for you. And if you look at any success stories from people where they're asking, hey, how did you become successful? Most people are not chasing necessarily the money. Maybe they're doing it because they love doing it, or it just really drives them every day to get up and do that. And that's basically what shoves them forward. But chasing the money sometimes can hurt you. So strategic job changes. This is another thing to watch out for. Switching companies can yield 10 to 20% pay bumps, but switching companies every 2 to 3 years can be a red flag. If a employer sees that you're changing jobs every 2 to 3 years, they may not want to invest in you, and they may decide to go somewhere else with some other opportunity. Performance visibility, you want to document your wins. You want to align it with leadership goals that you have inside of that. So converting career growth into retirement wealth. So the rule of 50, this is any time that you get a pay increase, you want to save at least 50% of that, because the biggest thing is you want to avoid lifestyle creep. We're all guilty of it. Lifestyle creep can continue to rob from your paycheck, and even though you might be making $200,000 or $300,000 a year, you could be living paycheck to paycheck because of lifestyle creep. It never goes backwards. The more job pay increases that you have, the higher responsibilities and stuff like that, you only improve your lifestyle. So lifestyle creep can definitely rob from your future if you let it. And basically converting all that career growth, you want to talk about retirement plans. So 401ks, you want to maximize if you can. You want to increase contributions annually inside of that. You have other ways of side income that people will, even though they have a 9 to 5, they might have a side job where they're consulting, they're teaching, they're doing part-time work. That's not really going to disrupt their career. It's just added income. And then once you get into retirement, you have income in retirement. So there's pillars that you can depend on. You've got your guaranteed income, which guaranteed is taken with a grain of salt. Guaranteed can be Social Security. That could be taken away at any moment. Let's hope it doesn't. Pensions, again, not always guaranteed. They're going to be insured and everything else. But, anytime that you want to mention the word guarantee, you want to take it with a grain of salt. It doesn't mean it's always guaranteed. Something can happen, can go away with it. And then annuities. Annuities are a guaranteed source of income stream, but they are backed up with insurance. So if they go belly up, it can be a long time when you might get that income back. Portfolio withdrawals. So 401ks, IRAs, taxable investments inside of that. And then maybe in retirement, you want to choose an active income inside of that. So maybe you truly didn't want to fully retire. So you have some part-time work, maybe you have some consulting, and then possibly if you own rental property, rental income. Okay, so Social Security and passive income streams. This is another thing added in there. So Social Security and career income or earnings. So I've gotten this question before where people go, what do they take? They take your highest and they take your lowest. So their benefit structure is going to be based on your highest 35 years of indexed earnings. So if you earned higher income years, it's going to replace lower ones. So that's why inside of a career, inside of moving forward, you always want to be pushing that needle up, because your higher income years are going to replace your lower ones. If you start to burn out and not really move your income forward or anything else. It can harm you in Social Security those years. You want to be earning a little bit more. And delaying or claiming income or Social Security from 62 to 70 can increase your benefits up to 77%. That too can be taken with a grain of salt. If you pass away and let's say you don't have a spouse, easiest situation to bring up. Let's say if you start taking your income at 70 and you don't have anybody else and it's just you, and then you pass away at 75, well, your income, that basically goes away. So you lived 5 years in Social Security retirement, your Social Security goes away. It doesn't get passed down. The only time it gets passed down to a spouse or disabled child or anything else inside of that, to where the family needs money, and that was one source of income. So dual income, a spouse situation, you can kind of decide on what years you want to take it to possibly benefit your spouse. If they get the higher payout, delaying your Social Security benefits can work out, because sometimes taking it earlier over the existence of the lifetime of you, can be a higher payout compared to delaying. And I'm talking about overall payout. 62 to, let's say, 70. You could earn a little bit more in those years than taking it at 70 in that situation. So it's a moving pendulum inside of that. And sometimes we do Social Security optimization. We'll take a client's statement, what they're receiving, and then just try to base that out and help them make the best decision. So you can build passive income streams inside of retirement years. You can use a portfolio getting dividends and interest where they're paying you some dividends. Rental and real estate, be very, very careful with that. Being a landlord is not always what it's talked about or what it should be. It's a lot of work, a lot of risks inside of it too. You can have some royalties and licensing, art, music, anything else that you want to start using your intellectual property and making that some sort of income stream, you can. And then lastly is business equity. So if you own or co-own a business, that can be a little bit of passive income. So bridging the retirement gap. Once when we're all working, we get the steady stream of income. We get the paychecks. We get everything else that makes us feel good. But once you get closer to retirement, sometimes that, the fear of not having that paycheck, not having anything else, it creates this gap. So to bridge that gap in retirement, you're going to face it. You're going to want some sort of income stream, and you're going to want it to be able to back up your desired lifestyle expenses. So some strategies can be annuity strategies where you have an annuitization where they're paying you out for the remainder of your life. We talked about this in the last one, dividend growth portfolios where you're paid a dividend if you invest in a certain stock. Stocks that pay dividends can pay pretty good dividends, but there is a trade-off. A high dividend paying stock probably won't grow as much, so sometimes you can cannibalize that investment over time. And then laddered bonds and CDs inside of that. So using a bond strategy to give you a little bit of income to bridge that gap is always a good metric. So you also kind of want to use the risk-based way of investing inside of that. So, and there are a lot of risks to retirement income. Inflation, one of the biggest ones. It's going to, you're going to average about 2.5 to 3%. Not like a few years ago where inflation got up to 8%, where that was a big draw from portfolios, and a little bit of a worry of when is it going to come down. Right now, as I said, it's about 2.8 in the consumer, CPI numbers. So, we kind of want it to hover around 2.5 to 3%. Always something to keep in mind of that. And then you have market volatility. Market volatility, more people focus higher on market volatility than anything else. Market volatility, you're going to have certain years that the market's going to do good compared to when it isn't. There is a certain rule of thumb of investments and how much you want to be distributing, and sometimes taking more percentage out of portfolios can harm your portfolio. So you don't want to go over a certain threshold. The 4% threshold of retirement income or pulling that from your portfolio, that can cause a portfolio to drop a little bit more, because volatility always needs to be taken into place. So healthcare costs have risen. They've continued to rise. Don't seem like they're going to get any lower. So 7.5% was, what inflation of healthcare costs were in 2023. So that's always something, especially in retirement, because we're going to spend more time in the healthcare industry, or I would say in the health system, than anywhere else. So longevity risk of you outliving your money, even though right now it's 78 for men and 81 for women, most people are going to outlive that. So you always want to monitor your distribution schedules and anything else. And then lastly is tax changes. Tax changes can be a big component to whether or not if you're going to retire early or delay retirement and anything else. So tax changes can be big. All right, estate planning. So we get into September, we start to talk about estate planning, protecting your wealth, your values, and to leave it for generations in the future. So it matters. It really matters inside of estate planning, because you want to ensure that your loved ones are provided for. That's the biggest thing. If something was to happen to you, what's going to happen to them? Planning for estate planning, having stuff put into either a trust or whatever else, you can minimize your taxes and legal costs inside of planning for it. Now, even though it's an upfront cost to deal with an attorney, an estate attorney, now it can really help you. And later on down the line, when you're not, let's say you do pass away, your family's not going to have to deal with the legal costs or the taxes. So you want to minimize that, as best as you can. It allows you to maintain control of your assets and how they're distributed. You want to preserve some family value and charitable goals if you have those. And lastly, it reduces conflict and uncertainty. Not always guaranteed. Reducing conflict and uncertainty, even though a estate plan is in use, this is not always going to be a guarantee. And that's something you can plan for the most inside of that, but that always is something, just kind of look at and keep in the back of your head. All right, wills versus trust. So wills, very, very simple. It's effective only after you die. So it's a public process, and it's simpler but less private. So, a will is just going to be a public situation, and it doesn't really, if something were to happen to you, let's say you become incapacitated, it doesn't come into effect until after you die. So that's why, trusts are way more effective. It's effective during your life and after death. So it gives you control, if, not control, but it allows you to give someone the control if you're incapacitated. And even after you pass away, it gives you what they call control from the grave. So you can determine how assets are distributed, where they go, in situations like that. So it does avoid probate, which is really good in the United States. Some certain states can be more challenging than others. And then it gives you more control and potential tax benefits. So that's for trusts. So tax and wealth transfer strategies. So the gift tax strategies, the annual exclusion right now per year is about $19,000 per person. So gifting someone money, they say about $19,000 per person. So the lifetime exemption, this is something that they were talking about changing and moving down lower. They didn't. So it's about $13.9 million per person. And for a married couple, it's about 27 million. So that is just, it allows you to, that's your lifetime exemption, lifetime assets, lifetime giving stuff. So that's what you're given. So charitable given, donor advised funds, and charitable trusts. If you are very charitable, if you're philanthropic and everything else, then you can basically use these strategies. You can use, in part of your trust, you can use charities as beneficiaries. You can also use life insurance as legacy tools. If you don't have the assets to back it up, you use a life insurance policy. And then the last thing is family limited partnerships and business succession planning, just kind of giving you a little bit of control of who it goes to. and how. So what does leaving a legacy mean to you? It could be way more than just material possessions and money. You want to be communicating your intentions to your heirs, right? Communication is key. Telling them where everything is, telling them what, your life meant, or how your life you know happened with everything, and just your ethos and your life, and what your mission statement was every year. Just communicating everything with your beneficiaries, with your children, just who you want to take over once you pass away, who you want it to take it over, and why. um, you can educate your beneficiaries on being a steward. It sums up kind of what your life has taught yourself, and then how you did that and how it makes others feel. So that's kind of a good thing to align that with. Aligning your wealth with your values. If you're a giving person and you intend to give and continue to give, you kind of want to align it that way as well. So common mistakes to avoid in estate planning is not to have a plan. Obviously, if you're not doing estate planning, you're not going to have a plan at all. But if you do have an estate plan, you want to make sure that documents in there are not outdated. You want to make sure your marriage licenses are up to date. If there was any divorces, you want to update those as well. And then children, beneficiaries, incorrect beneficiary designations, all of these, about every 5 years, they say to take a look and update your beneficiaries inside of there. It's just being able to have that. And then lack of liquidity to pay taxes and expenses. So if all of your assets are tied and there's no liquidity, it's tied to investments, you have to sell those investments to give your estate some liquidity, to give them basically basically ways to pay your taxes and expenses using a transfer on death account at a bank, payable on death account, where a beneficiary that you trust can come in and take over those assets. Having a trust bank account that's going to be there to pay taxes and expenses. You want to have a little bit of liquidity to be able to do that. And then just failing to communicate with your heirs. This is a big one. Heirs don't know where things are. Nobody knows they were a trustee until the last moment. Nobody knows what they need to be doing. It's just a big mistake because that trustee is going to make mistakes. The other family members may not like them. It can just be a mess. It really can be. All right. So your steps of getting started in estate planning. You want to take an inventory of your assets, right? What you have, where it is, where it's located, where the key is to the lockbox. Where do I hide money in the house? Just anything like that. You just want to take an inventory of all your assets and just make sure that you have a running tab of where everything is. Defining your goals and your vision of what your legacy means. I'm just trying to define all that and write it down. You can draft core documents with an estate attorney. That's the best. Of doing that, using an estate attorney, someone who's licensed in your state to give you legal advice. And by the way, all of this stuff that we mentioned, I'm not acting as a legal entity. We're not attorneys. We can't give legal advice. This is just general guide information. And then you want to review your beneficiary designations and titling, and then you can revisit and update those regularly. So about every 5 years. Sometime sooner if you want to do that. And again, sometimes paying the estate attorney those fees, not fun, but it can typically limit those disastrous situations. If something was to happen to you, your spouse, someone else, that you didn't plan for, certain things like that can happen. So, all right, well, that just kind of wraps everything up. And I do appreciate everybody joining and participating in this Java with Jayce, and I hope to see more of you in a lot more of these engagements. And looking forward to the fourth quarter year, and just basically seeing what that is, and just kind of seeing how the rest of the year turns out for us. So, thanks everybody for joining, and hope to see you guys soon. Take care. Bye.